Hi guys, in today's episode I'm going to go over some key concepts regarding market structure, so how to draw it in and how to use it to your advantage when trading the financial markets. So without further ado, let's dive straight in. So before going more in depth on how to draw in market structure, we have to first understand one of the underlying concepts which lies behind it. And this is multi-timeframe analysis. So what is it? Well, multi-timeframe analysis is a form of analysis during which traders analyze multiple timeframes in order to form an overall bias. Important to note is that the higher timeframes always take precedence over the analysis on the lower timeframes. And therefore, using a top-down approach, so going from the daily to the 4-hour to the 1-hour, ensures that you do not forget the bigger picture, and it prevents you from getting caught up on intraday and lower timeframe price action. When you're conducting multiple timeframe analysis, it is important to remember one major key concept, and that is that a trend on the lower timeframe is going to be an impulse on the higher timeframe, and an impulse on the higher timeframe is going to be a trend on the lower timeframe. So what does this look like? Well, as we can see over here, let me draw it in for you guys. We have an impulse on the higher timeframe, which is a trend towards the upside on the lower timeframe. So why is it important to understand this key concept? Well, as we can see, once you've identified higher highs and higher lows, and you know that you're in a higher timeframe uptrend, you can mark these higher highs and higher lows out, because these higher highs and higher lows are going to act as your higher timeframe support and resistance. So why is it important to draw in higher timeframe support and resistance? Well, these higher timeframe areas or key levels are going to be the areas where you expect the lower timeframe trend to reverse, so either find resistance from or find support from. As we can see over here in this drawing that I made for you guys, we have a 4-hour impulse, which is our trend over here. So we have a higher high on the 4-hour time frame, then we have our higher time frame pullback, which is also a trend on the lower time frame. So a new higher low is formed, and then once the previous higher time frame higher high gets broken, so in this situation, that is the higher high over here, we can then see that once that higher high is broken, we will eventually retest it. So that previous high, which was first resistance, is then going to be our next area of support. So as we can see, if we draw in those major higher time frame key levels, we can really see where the market is going to bounce, so find resistance and find support from. This concept is really key when drawing in market structure and trading the financial market in general. So let's dive into some real-time charts, as we can see here above. So let's just remove the drawings over there. And if we look at this 4-hour time frame chart, what can we then see? Well, let's draw in our major higher highs. This is going to be our high, and then we have our low over here. So as we can see, we had a 4-hour impulse, a 4-hour pullback, 4-hour impulse. However, we failed to break this low. So this is the major lower low, which needs to get broken for a higher time frame downtrend continuation. However, it doesn't occur. So as we can see, this is our most recent major low, and this is our previous most major higher time frame high. So if we then go to the 1-hour time frame, we can see, okay, this is a 4-hour impulse towards the upside. We've now reached a higher time frame key level. So if we go to the 1-hour time frame, we can see, okay, this 4-hour impulse is a 1-hour trend over here. As we can see, we have our impulse, our pullback, our impulse, our pullback, our impulse, boom, trend break. So where do we find resistance on the 1-hour time frame? We find resistance at our higher time frame key level. So once we find resistance at our higher time frame key level, we can then see that the lower time frame trend switches from the uptrend to the downtrend, right? So that is why we draw in our higher time frame market structure. Because when you draw in that market structure on the higher time frame, all you need to wait for is then a trend switch on the lower time frame to then say, okay, well, we can then take a short towards the downside, right? Right back down towards the next previous most higher time frame high. So as we can see, once we reach our previous higher time frame high, which was the higher time frame or the higher high on the higher time frame, we can see, okay, once that is retested and we form support, we can then see, okay, we're now moving back from that downtrend back in to an uptrend, right? And then where are we going to form resistance? We form resistance back at that major 4-hour high. So then what happens at a certain point? Boom. Once we break that 4-hour high over here, we can now see that the trend towards the upside is re-existing, and you can then anticipate on more higher highs and higher lows on the lower time frame to exist, which will most likely be a higher time frame impulse. And as we can see, this is all part of the 4-hour impulse back up towards the upside. So that, ladies and gentlemen, is why we draw in market structure on the higher time frame, because we can really easily use it to our advantage when trading on the lower time frame. So I hope you guys really enjoyed this episode. If you're interested in more, make sure to subscribe and leave a like. If you have any requests regarding any lessons or specific pairs for me to analyze for you, just please leave a comment in the comment section down below. Thank you all for watching, and I can't wait to see you all in the next episode. Thanks, guys.